All right, that should be about enough time. We'll have some people trickle in after we get started. So today we are going to actually do a webinar live update. In the past, I have typically videoed this and then released it to investors. However, I've had a couple of investors that wanted to ask some questions on the content that we created. So I decided, let's go ahead and try doing a online webinar to give the updates for the mortgage fund. Participants today are going to be people that are already invested in the fund. Some are invested in the trust deeds that we offer, and others are just interested in learning more about the mortgage fund. So we've got a good kind of cross section of participants today. As I had mentioned, feel free to use the Q&A at any time throughout the webinar. This is definitely the first webinar I'm going to be doing with as an update. So I'm interested to hear what questions investors have about the mortgage fund. Now we're going to go over a lot of numbers today. The numbers are going to be specific to the mortgage fund. They're not going to really include the trust deed portion of the business. As many of you are aware, we started doing trust deeds back in 2008, and we have since early 2021 have migrated more to a mortgage fund model. The biggest reason we've done that is simply because of the growth that we've had and trying to manage the number of investors that we've been able to grow with has been too difficult. So the mortgage fund model made much more sense, and then also for investors to create a more efficient means of investing in mortgages. So let's go ahead and kick it off. So for those that are not aware of who I am, my name is Brock VandenBerg. I run TaliMar Income Fund I. I'm a graduate of the University of Michigan with additional coursework in real estate finance from UCSD. Started in real estate finance in 2001 as a financial analyst for KeyBank, and spent about 6 years with KeyBank, where I transitioned over to the FDIC. Probably familiar with the FDIC. They're the ones that insure your deposits at financial institutions. Spent 2 years with the FDIC, assisted the FDIC in closing down failing banks in 2008. Great opportunity to kind of see the insides of a bank, why they failed. And about that time, I started to invest in trust deeds myself using my own capital. Around 2010 is kind of when I went outside to outside investor capital to invest in the trust deeds that I was originating. And when what we know as today, TaliMar Financial, the company, was really kind of kicked off at about that point. And then we went ahead and launched our mortgage fund, TaliMar Income Fund I, in early 2021. I am a licensed mortgage broker here in the state of California and a certified fund manager through the American Association of Private Lenders. Currently live here in San Diego with my wife and 3 children, and play competitive tennis. I know I keep saying that. Actually lost a match the other day, and it's okay though. She was a collegiate athlete, tennis pro over at one of the local colleges here. It was a great match, but she got me at the end. So I'll be back on the court though over Thanksgiving. Yeah, no questions about that. All right. So let's go ahead and start off, talk about some of the successes that we had in October for TaliMar Income Fund I. Number one, and most important, is that we had no late payments and no maturity or defaults. The mortgage fund is very healthy. We'll go through some of the numbers, but we've got 44 loans in the portfolio. All are paying on time, and we have no issues right now on the maturity defaults. Obviously, we're taking a very cautious approach on the servicing, ensuring that these payments are coming in. One of the things we do is constantly reach out to borrowers to ensure they understand the payments are due, when they are due, especially in today's volatile market. Seems to be paying off. The second bullet point is we've sold off nearly all our whole loans that are yielding less than 8%. As many of you are aware, over the last quarter, we've been selling off a lot of mortgages that are lower yielding, making room for higher yielding loans to be added to the portfolio. And it was a success. We were able to boost the return of the fund, I think, by almost a 1/4% by selling off those loans. It's one of the advantages of having a mortgage fund is that you can make decisions like that of taking loans that you no longer want in the portfolio, either because the risks have changed on that loan, it's yielding too low, or other reasons that you can go ahead and remove that loan from the portfolio. We've raised over 2.1 million in October, and then also here in September, with roughly another 700,000 set up to come into the fund over the next 30 days. One of the things that I keep hitting upon is that we have no exposure to land or construction loans in the portfolio. Land development loans, and construction loans typically offer the highest risk on a loan. And so we've really stayed away from that loan type. And so those have been, those are no longer, or we don't have any exposure to those in the fund. And finally, we earned a annualized net yield of 7.95% in October, should be October. That is a slight decrease from September. However, we are starting to see inflation creep in terms of vendor costs. So we're starting to see some of the costs associated with fund administration, with accounting, and then our upcoming audit. Those costs are increasing. And so we're starting to see that in the return of the fund. So let's talk about loan origination. October, we definitely saw a slowdown in the market in terms of loan origination. And we expected that. About 50% of our business are from fix and flippers. And those fix and flip investors aren't buying as many properties. They're a little concerned about what's going on in the market. Also, they have projects already on the balance sheet. Most of them are in the process of selling those. So those repeat customers right now are not buying new properties. So we saw new loan volume in October with 4 loans totaling 2.6 million. Now compare that to this time last year, where we funded 9 loans totaling 6.2 million. So you can definitely see that differentiation, that decrease in loan volume. Within the last 2 weeks, though, I will tell you that loan volume has increased substantially. Not that we're closing new loans, that we're getting a lot of new loan requests. And I think there's a couple of reasons for that. Number one, I think a lot of our investors are getting a little more comfortable with where the market is, especially here in San Diego. You're not seeing some dreaded increase in number of homes on the market. In fact, you actually saw a decline in the number of homes on the market since last month. So we're not seeing a massive new supply or oversupply of housing. And also, a lot of the properties that are being listed are actually selling. So this idea that homes aren't selling right now, we're just not seeing that as much. They're definitely not selling as quickly as they were, but they are selling. So I think that is contributing to the increase in the number of loans that we're seeing. Additionally, year-to-date loan volume, pretty interesting. We've actually closed the same number of loans this year at this time than we did last year. Now, what's different is the loan sizes appear to be a little smaller. That was interesting. I would have anticipated this year, just because of value increases since last year in property and in home values, we would have seen a larger or seen an increase in size of loans. Evidently, we did not. Last year, about this time, we did see a significant increase in loan volume in terms of loan closings. And I just don't think we're going to see that real spike at the end of this year. So let's break down the types of loans that we're originating. So this year, or about this time, and as I mentioned, we do about 50-50 split of loans, fix and flip and fix and hold loans. We had 2 loan closings, totaling 1.6 million, and then 2 bridge loans for 1.3 million. I do get the question a lot, Brock, what's the difference between a fix and flip and a fix and hold loan? The 2 big differences: on a fix and flip loan, the borrower is intending to update the property, and our takeout is either they're going to be the sale of the property, or in these today, it's more likely it's going to be a hold. So they're going to go ahead and rent it out and refinance us with conventional financing. The other big difference is we're underwriting to future value on a fix and flip. So we're taking a house in its current poor condition and we're taking a look at what that value of that property is once the renovations are completed. Bridge loans are based on current value. Typically, they're running maybe 6 to 18 months. Borrower may be using us to purchase a property. Their existing bank couldn't close quick enough, so they have to use private financing to close on it. Or maybe they're looking to do a cash out refinance of an existing loan that they have on the property. As you'll tell, no new construction loans. And then the 30-year rental loan, which these loans don't go in the mortgage fund, but we do, a lot of investors do ask if we do offer this kind of long-term rental property loans. We do. They were very popular at the end of last year when rates were low. You're not getting as many of these types of closings anymore as rates have increased substantially. To give you an idea of where 30-year rental rates were about this time last year, you could probably lock in a rate on the high 3 to low 4% range. And that made a lot of sense for properties here in San Diego. But now they're underwriting to 7.5 to mid 8% range. And so you're really actually getting into kind of a hard money pricing kind of strata for those loans. And so you're not seeing a lot of 30-year rental loans being closed, especially here in Southern California. They make more sense maybe in the Midwest or Southeast, where you see the income generated on a property is much, as a ratio to the value of that property is much closer than here in San Diego, where rents are nowhere near what the value of that property is. So loan servicing. Right now, we have 44 loans in the portfolio. The outstanding balance of the portfolio as of a couple of days ago, 24 million. The weighted average coupon is at 8.28%. So again, we're seeing a nice gradual increase in the general average rate of the loans in the portfolio. Our average loan to value ratio is just shy of 65%. Kind of where we're sticking, we're trying to target that 65% loan to value range. Gross monthly income for the fund is at $165,000. Obviously, that will grow as we put more and more mortgages into the fund, and also the average rate of those loans that are being put are increasing as well. As I mentioned earlier, we have no payment defaults and no maturity defaults at this time. I did make note that one of our focus points over the last quarter has been to really focus on working with borrowers and loans that we think may be problematic. Those may include fix and flip loans. We want to make sure the borrower is completing those renovations as quick as possible and that they're getting those listed on the market, or they're in the process of refinancing those loans. To give you an idea of where our loan portfolio is, our target market is our backyard, San Diego. Roughly 80% of the loans that are in the portfolio are here in the San Diego County market. The rest are scattered throughout Southern California and some in Central California. We'll continue to focus over, I'd say, the medium term, at least for the next 12 to 24 months, to focus on properties in the San Diego County market. There was a great question from a investor during our last webinar. How much volume do you anticipate on just focusing in San Diego? I'd anticipate there's about, we could grow the fund to about 75 million and still have enough deal volume to fund here in just San Diego alone. When you start getting above 75 million, unless you're doing much larger loans in San Diego, you'll have to look at originating in other urban markets like our Orange County, LA, and San Francisco markets. By loan type, so a little over 50% of our loans are bridge loans. I anticipate over the next 12 months that gap will increase. I just don't see a huge market right now for fix and flippers. There definitely is a market there. The problem, though, is that the uncertainty and the volatility in the market for our investors. Like I said, there are still buyers out there, and some are buying up properties, but at nowhere near what we were seeing earlier this year, and I'd say over the last couple of years. So I would anticipate bridge loans becoming maybe 60 to 70% of our loan portfolio over the next 6 months, as some of these fix and flip loans get paid off. by property type, overwhelmingly SFR 1 to 4, roughly 75% of our portfolio are single family homes. Now, I anticipate that percentage to come down as the fund grows and we're in a position to do larger loans. I anticipate us to have much more exposure to multifamily, commercial, and industrial. So right now, again, we're about 24 million. We're targeting loan sizes north of 1 million, sub 3 million. And so when you start to get to those loan sizes, you do get into more of a multifamily, commercial, and industrial property type. So let's talk about our transaction history here in the fund. So as I mentioned, we have 44 loans in the portfolio, totaling over 24 million. We've had 33 loans pay off, so a little over 14 million, with total transaction volume of 77 loans, totaling over 38 million. Now that compares with our general population of loans here at TaliMar. I think we broke 850 loans when we're creeping in about 350 million in total loan volume. If you were to take a comparison of our mortgage fund to our total assets under management, so that includes all our private beneficiary loans or loans that are invested on directly by beneficiaries, the mortgage fund makes up about 50% of that. So we have a little over 50 million that we currently manage, so loan balances that are outstanding. Again, that's going to skew towards the mortgage fund as we raise more and more capital for the fund, and we place more and more loans into the fund. For those that invest in trust deeds, I think a common question you get, okay, well, how do you select loans that are going to go into the mortgage fund versus loans that go to private beneficiaries? Well, the majority of loans that we originate are going to go into the fund, assuming that we have the liquidity into the fund. So the mortgage fund has essentially first right of refusal for those loans. And then if we don't have liquidity in the fund, I'll go ahead and make those available on our traditional trust deed platform. Occasionally, we'll originate loans that I feel are good loans, but don't meet the parameters of the mortgage fund. And again, those will go direct to trust deed investors. So let's look at fund statistics. Total capital in funds, so total investor capital that we've raised that is active in the fund as of today is roughly 23.5 million. We have cash on the balance sheet of just shy of 420,000. Now, that's something that I do keep an eye on. Cash that's sitting in the account doesn't earn income for the fund. And so we try to keep that to literally zero, to put have as little cash in the fund as possible, and really rely on that credit line that we have if you have any cash requirements. So right now the credit line balance is zero. We've had that for a while now. As we bring in new loan volume, we've got a couple loans on the docket for closing here next week. You'll see that cash, the cash on the account go down. But right now about a little under 420 in cash in the account. Currently have 98 investors. We should be popping over 100 investors here in the next week as we process new investor accounts that are coming in. And as I mentioned, the October net yield to the investor was 7.95%. One of the other reasons why we're trying to grow the fund as quick as possible as well is to reduce the monthly expenses as a percentage of assets under management. What do I mean by that? So roughly, we've got about 6,000, about 6,500 a month in just general expenses. These aren't expenses being paid to me. These are just your accounting expenses, your fund administration expenses, and all the other expenses of just managing the mortgage fund. Now, those expenses are fairly static. And so as you increase the amount of capital in the fund, they become a smaller percentage of the assets under management, which is why we're trying to get to that 30 million mark. That's our year-end goal right now, is to get 30 million in the fund. And we should be able to drop that assets under management or costs of the fund expenses to roughly around 25 to 27.5% of the assets under management. So I thought this was an interesting stat. What this shows right now are the returns the investors have made on a monthly basis. So you'll notice you saw a significant decline. So here we're just over 7.8% in November of 2021, and you saw a definite decrease down to a little over 7% going into March. Now, we were in a very competitive market there on the lending side. There was a lot of capital in the market. You didn't see any significant increases in Fed rate by that point. A lot of investors were buying up properties very quickly before the anticipated rate increases. As soon as March hit, though, you saw a significant jump back up on the fund. And there was a number of reasons. Number one, we were closing a lot more loans at much higher returns. So you saw that creep in. Secondarily, this is about the time we started considering selling off lower yielding loans. So you saw the positive effects of selling off those lower yielding loans. Then you kind of jumping back and forth here. This is when the rate started to significantly increase. Loan volume became a little volatile, choppy as we were trying to bring in new loan volume. But then you saw another significant increase here in terms of returns, and that's when we were again replacing and bringing in higher yielding loans. And then you just saw a slight decrease again. I think it was probably about 20 basis points drop, and that's where you're starting to see the inflation from our vendors. So the cost increases are starting to creep in to the mortgage fund. I fully anticipate us jumping above again 8% next month, and we should start our target return to investors by mid Q1 should be around 8.5%, based upon the rates that we are bringing in on the loans that we're closing over the next couple of months. So fund update, as I mentioned, transaction volume has just decreased as expected. There's not a lot of there's about 50% less transactions that are occurring today compared to 6 months ago. So we anticipated a decrease in transaction volume, though we do see sufficient transaction volume to ensure that the funds that we have in the fund are always deployed. There definitely is what I call borrower price discovery. So right now we're quoting loans in the 10 to 10.25% note rate range. And I think that right now our investors are a little thrown back by those rates. They didn't anticipate rates to jump so quickly on hard money loans. So you're starting to see some of that price discovery. So you're starting to see borrowers call around to see, hey, maybe they can find better rates elsewhere. And that just isn't the case. That's kind of what the going rate here in Southern California for a good first trust deed is. Inflation, as I talked about, has begun to affect fund management costs. We're starting to see increases. In fact, I think our fund management fees jumped by a little over 10%. And then the accounting fees we anticipate as a jump there as well. Home prices have seen a modest decline. Again, with rates going up, we anticipated it. But I think that the media had really kind of overplayed their discussion points on this. In San Diego, inventory remains at historic lows. Yes, we've seen some price declines, but if you look over a year-over-year return or year-on-year price comparisons, I think we're still above last year by over 10%. So you're still seeing that there's a significant price increase when in comparisons to last year. Those sellers that are out there many of them have actually taken their home off the market, which has contributed to this low inventory. Those that were considering selling are not selling. A lot of these home buyers want peak pricing for their sales. They're not going to get it, hence they're not going to sell the property. So you're not seeing that just crash in the market. It's interesting, just today I saw in the Wall Street Journal, there was an article, and it was kind of going over the fact that we're not seeing a significant crash in the general economy as well. And I would agree, we still see employment numbers are still pretty good. Obviously, we see the headlines from some of the tech firms and the layoffs that they have, but you're not really seeing that impact here in the markets that we're lending in. And then the final thing I said is shift away from fix and flip to standard bridge loans. And I think you're going to see that again over the next 6 months. I don't think the flipping business is going to be anywhere near the size of what it was last year and earlier this year. And I say that for a considerable amount of time. what really fuels that fix and flip business, number one, is you need to have an inventory to buy the house. Okay. Number two, you really need kind of a strong market. And I'm not saying that the prices have to be going up by 10% or so, but you got to have some type of increase in values to make it work. So I don't think that, without those two components, that you're going to see a significant increase in the amount of fix and flip projects that are going on. Standard bridge loans, absolutely. I think banks have become even more conservative in their underwriting. We're seeing a lot of bank fallouts right now for what I felt are very bankable borrowers. So these are borrowers that have good credit. They show cash flow. The real estate that they're buying or they're refinancing is very good real estate. In fact, we're underwriting a commercial loan right now in an auto body shop, and we quoted a rate significantly higher than 10% for this, and we're at 50% loan to value with a very strong borrower. So it just goes to show you that there's a niche that this private lending market fills, and as there's volatility in the market, the opportunity for our industry and companies like TaliMar Financial really blossom and grow in these kinds of markets. If you start to see a lot of steadiness in the market, banks come back in with cheap capital, that's where it becomes more difficult for a private lender to really drive yields. So I'm really excited what 2023 has to offer, because I feel that banks are going to remain conservative in their underwriting, which will just leave more opportunity for us to really target what I feel are strong borrowers and strong markets. So common questions that I am getting from my investors is, number one, when should I expect the monthly distribution? Probably the most common question. So we're really shooting for the 15th. But keep in mind that trying to close out a prior month transaction, especially as we grow and the number of transactions we're doing grows, it's difficult. And so our expectation right now with our fund administrator is to have distributions done by the 15th. I think right now we're just a couple days late after the 15th. Are there income caps on the qualified business income tax deduction? So what does that mean? So many of you know that by investing in or TaliMar Financial, the mortgage fund is structured as a REIT, right? So a real estate investment trust, and there's significant tax advantages for people that are investing not only in their accounts like IRAs and whatnot, retirement accounts, but also with your existing funds. One of those tax benefits is the qualified business income tax deduction. And without really going into the weeds of it, essentially what you're doing is you're only getting taxed on 80% of the income. The other 20% is a write-off. And so one of the questions I have is that with QBI, there are caps on if you can get that tax deduction if you make over a certain amount of income. Well, because it's structured as a REIT, those caps don't exist. And so no matter how much money you make, you still qualify for that tax deduction, that 20% tax deduction on the income generated from the fund. Now, the question is, what is the minimum amount to increase my investment? Minimum amount beyond the $50,000 initial minimum requirement is $1,000. Do you get an annual audit? The answer is we're in our first full year. We will be getting our first audit at the beginning of this year for 2022 and 2021. And who is Verivest and why do I get emails from them? So Verivest is what we call our fund administrator. They're the ones that are actually doing the physical accounting. So we've outsourced all the accounting for the fund. A lot of our investors like that simply because it acts as a third party, kind of reviewing the numbers. They do a good, and number two, they're just set up to do fund administration. I think they probably administer 100 plus funds, including mortgage funds. So when you get your monthly statements, they're the ones that are actually sending it out. They do what's called a white label. It'll say TaliMar Financial over all the paperwork and statements, but they're the ones that actually send those statements out. That's why when you log into their portal to get your statement, that's why we have a separate portal for that. All right, so what to expect in 2023. So many of you probably have seen that we're doing a lot more webinars with industry experts. I had Brian Davis of AccuPlan on about a month ago to talk about self-directed IRAs. I've got Gabe Candia coming up at the end of middle of next month to talk about the Delaware statutory trust. So people that are interested in learning about 1031 exchanges and to do a Delaware statutory trust, his company specializes in doing that. We're going to have a market analyst coming in January to talk about the current real estate market. So we're going to continue to do that, have an industry expert once a month on these webinars. Obviously, they're free to you. Love to have you come in and listen to these experts. We're also going to be doing quarterly investor events. So February 1st, we have our first investor dinner scheduled here in San Diego. I'll go ahead and send out invites to our investors to schedule that to be there for the dinner. But what I'd also like to do is have those events up in Orange County, Los Angeles, San Francisco, and other markets where our investors are. I'll go ahead and reach out to our investors and let you know the dates on those investor dinners. Coming out of COVID, you kind of forgot about meeting people in person. So for many of my investors, I've never actually met in person. I've done Zoom calls and phone calls, never actually met you in person. So I'm excited to be hosting these dinners. We're going to have a heavy focus on our capital raise. Our goal for next year is going to be to get our fund above 50 million. We're at 24 right now. Our year-end goal is at 30. So we're going to be heavily focused on raising more money for the mortgage fund. And then I'd like to do these webinars on a monthly basis. I think that they are great. I think that this is an opportunity for people to ask questions in real time, for me to present new ideas to you in a real-time format. So we're going to go ahead and try this and see how it works. So those that are not familiar with the fund, that may be interested in learning more about the fund, we are a Reg D 501c fund, so we require only accredited investors. We focus on residential and commercial private money mortgages. So these are mortgages to real estate investors, both on residential and commercial properties. Our primary exposure is going to be here in San Diego over kind of the short term, medium term. We're going to be looking to do Southern California, and then longer term, we'll probably grow throughout California and some states on the West Coast. We offer distributions on a monthly basis, and you have the option to reinvest your distributions, or you can take that distribution as a check every month. We are an open-ended fund, so you can come in and come out as you like, and we have no lockup period. So if you invest and are not comfortable with the investment, you can always pull your money out. Common question I get is, how liquid are you? We're a relatively liquid fund. I think the last distribution that we made was within 24 hours that somebody took a withdrawal. So depending upon the loan size or the amount that you're looking to withdraw, we're relatively liquid. Talked about assets under management. Our October yield was at 7.95%, with our target yield over the next quarter of between 8.25% and 8.5%. I think we'll be able to reach here by the end of Q1. And then one of the advantages that we offer, and a lot of people do get concerned, is about understanding the underlying loans in the portfolio. So I want to take a quick sec and show people that have not logged into the lender portal how you can do it. So this is the lender portal. You can get to the portal by going to TaliMar Financial, our website. Simply go to investing and go to your investor portal. Once you get to the lender portal, if you don't have an account, just go ahead and select create new account. I'm going to go ahead and created a account here. See if I can't get to it. And what you'll see is when you log in is going to be your dashboard, and that account name is our example lender account. You'll be see what the status of the account is on the dashboard, your account number. You'll be able to see how much you have invested in the mortgage fund. And then if you're invested in trust deeds, you'll be able to view all your trust deeds here as well. If you're only interested in investing in trust deeds, you can select your trustee portfolio, and this will list out all the trustees that you're currently invested in, including the payment status and the status of the loan. We also post all our available trustees. So right now we've got one posted. That's going to be coming soon. Now keep in mind, when we post trustees, they don't necessarily mean that they're going to come to or be available to individual trustee investors. Obviously, we're constantly raising money for the mortgage fund. And so those loans may be put into the mortgage fund. If you've got a question about a trustee that you can't select the Learn More button that isn't available to view, feel free to reach out to me or my investor relations team. We'd be more than happy to give you an update as to what is happening with that trustee. The mortgage fund tab is if you're invested in the mortgage fund, this is all the information you need about the mortgage fund. So you can view your account information. Here's my example lender account with how much I have invested in the fund with my distribution type and account status. Now, what's really cool is we're going to be adding very shortly another column here, and you'll be able to actually, for those that reinvest their proceeds, you'll actually be able to see your distribution history. So you'll be able to see how much you've reinvested into the fund and see that history. That should be rolled out here probably in the next week to 2 weeks. Included on the tab, you'll be able to see a portfolio overview. This is connected to our database, and so it's real time. Every time a loan pays off or every time we add a loan to the portfolio, what you see is going to be updated here. So I have a lot of investors that log in every morning just to view what the current overview of the portfolio looks like. So you'll be able to see the number of loans that we have in the portfolio, current outstanding balance, average loan size, average yield, loan to value, all of these numbers you can view by simply going into the lender portal, and it's real time. You'll also be able to view the loan by loan type, by property type, by state. Now you're going to primarily see the state of California, and then ownership type. So do we own a full ownership in the loan or a fractional ownership in the loan? You'll also be able to view the loan schedule. So you actually go down to the loan schedule level, loan detail, and view all that information on the loan. So by city, state, property type, loan type, balance, lender rate, and be able to go down to loan status as well. So if we had any non-performing loans in the portfolio, you'd be able to view it there. If you're interested in learning more about the fund, you can obviously go ahead and select Executive Summary. We'll go ahead and email you a copy of the Executive Summary. And you'll also be able to add funds as well. So if you're interested in adding additional funds to the mortgage fund, you can go ahead and select that link and go ahead and submit your request. So that about does it with our November update. I appreciate those that have logged in, those that are currently invested in the fund. Thank you very much. Those that are considering an investment in the fund, feel free to reach out to me. I've added actually a QR code there if you know how to use your phone, put it in picture mode, and go ahead and just take your phone and scroll into that photo. You have access to the executive summary. If you got any questions, feel free to reach out to me. Here's my email address. Here's my phone number. Love to chat trustees. Love to chat mortgage fund. We do have an upcoming webinar at the end of this month about how I underwrite trustees. If you're interested in learning about how what I use, the strategies I use to invest in trustees, feel free to go onto that webinar. And as I had mentioned as well, on mid-December, we'll have Gabe Candia from Perch Wealth talking about Delaware statutory trusts. So thanks again. Doesn't look like we've got any questions in the QA. So if anybody's got a question, go ahead and select QA and go ahead and submit your question. If not, again, thanks for attending. Have a great Thanksgiving with you and your family, and looking forward to connecting with you next week. Thank you very much.